The rain had stopped an hour ago, but the glow from apartment windows still reflected across the wet pavement like scattered stock charts. Inside a suburban kitchen outside Phoenix, two men were staring at the same market. One of them felt brilliant, the other felt responsible. Jason was 43 years old, works in software sales, owns individual tech stocks. Talks about artificial intelligence the way people talked about the internet in 1999 and crypto in 2021. His portfolio was up almost 70% in a year. He refreshed his brokerage account constantly. Every green candle felt like validation. Every dip looked temporary. The other man, Eric, lived 3 houses down. 58 years old, quiet, doesn't trade, owns index funds. Contributes automatically every month through his retirement account because that's what financially responsible adults are supposed to do. He thinks he avoided the insanity. He thinks he stayed diversified. He thinks he chose safety. But here's the strange part. If you open both portfolios side by side, they were both heavily dependent on the exact same companies. The same handful of tech giants, the same AI trade, the same concentration, the same invisible risk. One person knew he was gambling. The other thought he wasn't, and that difference matters more than most people realize. Because the stock market is starting to feel less like an investment system, and more like a giant psychological machine powered by passive money, artificial intelligence hype, leverage, and the collective belief that prices are supposed to keep going up forever. That's not normal, and the market knows it. My name is Theo, and I spend way too much time thinking about why financial systems always look safest right before they become dangerous. If you're someone who has money in retirement accounts, index funds, pension funds, ETFs, or anything tied to the stock market, and you've started quietly wondering whether something underneath this rally feels strange, hit like and subscribe if this video helps you think about the system differently. Because what's happening right now is bigger than a normal bull market. And the uncomfortable part is that most people inside it can't even see the concentration anymore. That's how bubbles work. They stop looking irrational. They start looking inevitable, and that's where things get dangerous. A few years ago, diversification actually meant something. Owning the S&P 500 meant exposure to hundreds of companies spread across different sectors of the American economy. Banks, manufacturing, healthcare, energy, consumer products, retail, transportation. But today, a massive percentage of the market's movement is increasingly controlled by a tiny handful of companies. A few names quietly dominate everything, not just the headlines. The actual structure underneath the market? This is the part people miss. Millions of Americans believe they're spreading risk, while passive investing systems are mathematically concentrating it. The larger these companies become, the more index funds are forced to buy them, not because humans analyze them, not because investors consciously decided they deserved more capital, but because the math chose it for you. That matters. Because once enough money flows automatically into the same assets, price itself starts becoming the justification for higher prices. And then the feedback loop begins. Higher stock prices attract more passive inflows. More inflows push prices even higher. Higher prices increase index weighting. Increased weighting forces retirement accounts to buy even more. And suddenly the system no longer behaves like rational investing. It behaves like momentum gravity. Nobody talks about this enough. Passive investing was supposed to reduce emotional decision-making. Instead, it may have quietly created one of the largest concentration machines in financial history. And the scary part? Most people participating in it don't realize they're participating at all. They think they own the market, but increasingly, they own a few gigantic technology companies wearing the mask of diversification. Now here's where it gets weird. The entire AI race accelerated this dynamic into something almost surreal. Right now, a small number of companies are spending amounts of money that feel difficult for the human brain to even process. Data centers, semiconductors, energy infrastructure, server farms, AI training systems. One company spends tens of billions. Then another announces even more. Then competitors panic and increase spending too because nobody wants to be left behind. At some point it stops feeling like business expansion and starts feeling like an arms race. 4 or 5 corporations are now deploying capital at scales that resemble national infrastructure programs. Entire regions are reshaping power grids because artificial intelligence requires so much electricity. Tiny towns suddenly become strategic locations because they sit near energy capacity. Construction firms can't keep up, Chip demand explodes. Valuations expand even faster. And Wall Street interprets all of it as proof that prices should continue climbing. But the problem is, massive spending doesn't automatically guarantee massive profits. History is full of revolutionary technologies that changed the world while destroying investors. Railroads changed civilization. Most railroad investors still got crushed. The internet transformed humanity. Thousands of dot-com companies disappeared anyway. That's the dangerous psychological trap. When something truly revolutionary appears, people start assuming every price becomes reasonable, every valuation becomes justified, every concern sounds outdated, and the market begins pricing perfection into the future. That's what bubbles do, not because people are stupid. Because euphoria changes how humans interpret risk. You stop asking whether growth is sustainable. You start assuming growth is destiny. Now think about what's happening psychologically inside millions of ordinary investors. A school teacher opens her retirement account after work and sees gains she hasn't seen in years. A 49-year-old accountant checks his phone at dinner and realizes one AI stock made more money in 6 months than his salary. A young couple in Denver decides maybe they should finally start investing because everyone else seems to be making money. That emotional environment matters more than earnings reports. Because markets are social systems before they're mathematical systems. And social systems become unstable when fear disappears. That's why every major bubble in history eventually develops the exact same emotional atmosphere. 1929. .com. Housing. Different assets. Different technology. Different language. Same human behavior. At the peak of the dot-com bubble, companies with no profits were treated like future empires simply because they had internet exposure. People laughed at caution. Traditional valuation looked obsolete. Old investors were mocked for not understanding the future. Sound familiar? In 2006, Americans convinced themselves housing prices couldn't meaningfully fall nationwide because real estate was safe. Banks leveraged aggressively because default models assumed stability. Consumers borrowed recklessly because rising prices made everybody feel richer. And then the math broke. That's the part people forget about bubbles. They don't collapse because everyone suddenly becomes irrational. They collapse because the system quietly becomes too fragile to absorb disappointment. That's different, and fragility is building again. Not always in obvious ways. Sometimes in tiny cracks most people ignore, like market breadth. The headlines say the market is strong, but underneath? A relatively small group of companies often carries an enormous share of total performance. That's not broad confidence. That's concentration. Or corporate debt. For years, cheap money encouraged aggressive borrowing. Companies refinanced endlessly because low interest rates made leverage feel harmless. Consumers did it too. Governments definitely did it. Now rates are higher. Debt costs more. And suddenly the financial system has less room for mistakes. That matters because modern markets are heavily dependent on liquidity, easy money, cheap borrowing, constant inflows. The entire machine becomes unstable when liquidity tightens. This is where things get uncomfortable. Because most investors today have never truly experienced a prolonged market environment where money is expensive. Many younger investors grew up almost entirely during an era of central bank intervention. Every crisis eventually got rescued. Every major decline eventually recovered. Buy the dip became psychologically embedded into the culture itself. But markets train behavior. And when investors become conditioned to believe rescue is inevitable, risk-taking quietly expands beyond what people realize. That's how leverage sneaks into systems. Not dramatically, gradually. A hedge fund increases exposure because volatility stayed low for too long. Retail traders buy options because everyone online appears to be making easy money. Institutions chase performance because underperforming during a euphoric market can be career suicide. And then everybody becomes connected to the same trade. That's the hidden danger. Modern markets are deeply interconnected psychologically. And technology accelerated this even further. One viral clip, one earnings report, one AI announcement, one Federal Reserve sentence. Suddenly trillions of dollars emotionally reposition at the same time. This is not the slow-moving stock market of previous generations anymore. It's faster, more crowded, more reflexive, and far more dependent on confidence than people want to admit. Now watch what smart money is quietly doing underneath the excitement. Not what they say publicly. What they actually do. Warren Buffett has accumulated staggering amounts of cash. Stanley Druckenmiller openly discusses concerns about long-term fiscal instability and market excess. Michael Burry keeps warning about passive investing distortions and speculative behavior. Ray Dalio repeatedly talks about debt cycles and structural imbalances. These people disagree about many things. But notice the pattern, none of them sound euphoric. Because experienced investors understand something ordinary investors usually learn too late. The most dangerous periods rarely feel dangerous in real time. They feel exciting, comfortable, profitable. Bubbles don't announce themselves as bubbles. They disguise themselves as progress. That's why people get trapped. And this is where the psychology becomes genuinely unsettling. Human beings anchor emotionally to rising prices incredibly fast. A portfolio that jumps 40% starts feeling normal after a few months. Then expectations shift. Now investors need another 20%. Then another. Greed recalibrates constantly. That's why people buy near tops. Not because they suddenly become reckless. Because rising markets slowly erase memory. The memory of risk fades. The memory of pain fades. The memory of previous crashes starts feeling abstract. Especially after years of gains, and meanwhile, passive systems continue buying automatically. 401 KSS. Pensions. Target date funds. Index inflows. Every paycheck pushes more capital into the same concentrated system. Again and again. Month after month. Regardless of valuation. Regardless of risk. Regardless of whether the underlying assumptions still make sense. Nobody rings a bell when concentration becomes dangerous. That's what makes this so psychologically difficult. The system can continue working far longer than logic suggests. That's true. Maybe AI genuinely transforms the economy. Maybe productivity explodes. Maybe these companies grow into their valuations. Maybe the market continues climbing for years. That's possible. But bubbles always contain elements of truth. The internet really did change the world. Housing really was important. Railroads really did reshape civilization. The danger comes when real innovation merges with speculative psychology and unlimited optimism. That combination becomes combustible. And the market right now increasingly feels like a room where nobody wants to acknowledge how dependent everything has become on the same narrative. AI growth, continued liquidity, stable consumers, strong earnings, falling inflation, perfect execution, no geopolitical shocks, no credit accidents, no major slowdown, no disruption to passive inflows. That's a lot of perfection, and perfection is fragile, especially in leveraged systems. Now imagine a crowded theater where everyone believes the exits will remain accessible forever. As long as people leave gradually, everything feels fine. But panic changes math. Liquidity disappears faster than people expect. Buyers vanish. Correlations suddenly move together. Assets that looked diversified stop behaving independently. And then people discover they were all standing on the same side of the boat. That's the hidden risk inside modern markets. Not just valuation, synchronization, the terrifying possibility that millions of people think they're diversified, while the system underneath them became increasingly dependent on the exact same drivers. This is why the market feels dangerous right now. Not because collapse is guaranteed. Not because doom is inevitable. Because fragility is difficult to see during euphoria. And because human beings consistently mistake rising prices for reduced risk, when historically, rising prices often create more risk. That inversion destroys people, especially near major turning points. The strange thing about financial history is that every generation believes it finally found the permanent formula. Then reality interrupts, sometimes slowly, sometimes violently. And afterward, everybody claims the warning signs were obvious, but they never feel obvious in real time. In real time, the music is still playing. People are still getting rich. Neighbors are still bragging about returns. Financial television still sounds optimistic. Retirement accounts still look healthy. That's why it becomes psychologically difficult to step back and ask the uncomfortable question. What if the system became far more fragile than it appears? What if the concentration itself is the risk? What if passive investing changed market behavior more than people realize? What if the illusion of safety is partially created by the very inflows keeping prices elevated? And what happens if confidence ever breaks at scale? Because confidence is the invisible infrastructure underneath every financial system. Once people trust the machine, they stop questioning it. Until suddenly they do, and that shift is usually where history changes. Maybe this market keeps climbing. Maybe artificial intelligence creates an entirely new economic era. Maybe today's valuations eventually make sense. But if something underneath this system breaks, most ordinary investors won't escape in time. Because they won't realize they were concentrated until the diversification illusion disappears. And by then, the exits usually look much smaller than they did on the way in. The music is still playing. And that's exactly why it feels dangerous. Thank you so much for watching this video, and don't forget to subscribe to see the latest videos. I wish you success.